What's up guys, it's Sebastian here with Investing and Stuff, and today I wanted to do a quick video to talk about some of the most common misconceptions that I see people who are new to the stock market making, so that by the end of the video you'll have a better understanding of what you're doing in the stock market. Let's check it out. Okay, the number one most common misconception that I see people who are new to the stock market making is thinking that somehow the share price indicates how expensive a company is, and that couldn't be further from the truth. Let me give you an example. Let's say that you're trying to start a business, let's say it's a grocery store, and let's say that it's valued at $1 million. Now that's a lot, but compared to Apple, which is valued at $2 trillion, it's really not that much. Now let's say that your store that's valued at $1 million only has 1,000 shares. Now even though a share of your store is worth $1,000 and a share of Apple is worth about $120 at the time of me filming this, it doesn't mean that your entire store is valued higher than Apple. Apple is currently valued at $2 trillion. It simply means that your store has less shares. So whenever you're comparing two stocks, let's say that you're comparing Apple, which is $120 or so, and let's say that you're comparing it with Facebook, which is about $260, it doesn't mean that Facebook, the company, is more expensive because the share price is more. So if you're buying a share of Apple, you're probably owning a smaller percentage of Apple than if you were to be buying a share of Facebook. Also, nowadays almost all brokers allow you to buy fractional shares, so really you shouldn't be thinking too much at all about a company's share price. Now, if we want to value a company, we would probably look at the market cap, which is the entire valuation for the entire company. We would look at stuff such as the PE ratio per one share, the price to sales ratio, and many other factors, but really the price of the share has nothing to do with it. Okay, and the second misconception that I see newbies making is saying stuff like, this company is good, so therefore buying its shares is also good. Or this company is the future, let's say it's an electric vehicle company or something like that, so therefore buying it is automatically good. Now this is obviously also false, and it always depends, at least to some extent, on their valuation. For instance, Tesla may or may not be the future, but even so, it doesn't mean that you should be willing to pay an infinite amount for one of its shares. Even if Tesla were to become the greatest company in the future, it would still have some sort of valuation, so it doesn't automatically mean that buying Tesla or buying EV stocks or buying something that is a good company or the future is a good thing. It always depends, at least to some extent, on the valuation. Now, by the way, if you guys are getting some value and you're not yet subscribed to this channel, please consider subscribing so you'll be notified when I post more in the future. Okay, and the third most common misconception that I see people who are new to the stock market making is thinking that they have to use stop losses. Now this is only partially false. For instance, if you're a day trader or if you're a momentum trader, then maybe using a stop loss does make sense because you don't want to lose your entire investment. However, if you're a long-term investor and you have a medium to long-term horizon, so let's say maybe 5 to 10 or even 20 years in the stock market, I personally think that that's one of the stupidest things you can do, because really if you've done your due diligence on a company, if you want to own the stock, then you should be thinking how you can buy more when its shares are lower, not thinking about how you can sell the stock because the shares got lower. So really it's the old saying, buy low, sell high, but nowadays it seems that many new investors are kind of thinking how they can buy high and hopefully sell higher. Okay, and the fourth most common misconception that I see newbies making is having unrealistic expectations about what kind of returns they can get in the stock market. So many times I'll see questions such as, how can I double my money within the next month? Or how can I triple my money within a few weeks? And what you have to understand is that that kind of stuff is actually extremely rare, and doing so would require you to take quite a bit of risk. So in many cases you would risk losing all of your money into such a trade. In certain cases you might even risk losing more than what you deposited if you're using leverage. So personally, given that I invested quite a bit of my money in the stock market, I'm not really looking to double my money within the next month or so with the risk of losing it all. Okay, and the next misconception which I wanted to address is dividend yield chasing. This simply means that sometimes people who are newer to the stock market only look at how much a company pays out in dividends to decide what type of company to buy in their portfolio. Now, this is usually a pretty poor investing strategy because most of the companies that have really high dividend yields typically don't invest a lot of their profits into further growing the company because they're paying out so much in dividends. Okay, and the final misconception, or in this case it's more of a mistake that I see newbies making in the stock market, is FOMO buying something whenever it's going up and then panic selling it whenever it's going down. So this kind of ties into some of my previous points, but basically a lot of the times if the market is going down, I see a lot of questions on Facebook groups that I'm in with people asking, hey, what's wrong with the stock market? It's like nothing is wrong. The stocks were simply tremendously overvalued and right now they're getting some semblance of reality. If you buy something that's extremely overvalued, then sure, it might even go up another 100% or so, but don't be surprised if you're losing even 90% or more of your capital. Because probably when you bought the stock, if that's the case, you didn't do any sort of research into the valuation of the company, you just bought it hoping that somebody else would buy it higher. Also, even if you take a look at the recent, let's say, market crash that we kind of had, at least in the tech sector and in the EV sector and in the SPACs, I guess you probably saw that these more speculative assets crashed a lot harder than the overall market. So whereas the S&P barely dropped about 5% or so, these speculative stocks dropped even 40% or more. So if that's your strategy, then that's fine, but you should at least know what you're getting into. Anywho, that was all I had for today. If you liked the video, please give it a thumbs up. It helps support the channel. Thank you so much for doing that, and I'll see you in the next one. Bye bye.